Hello friends, this is Manoj Bhuptani. I welcome you all on behalf of the Edupedia world. I'm sure you guys are having a great time today, and certainly you guys are honoring your word of making regular revisions time and again. By now we have already covered more than 50% of the topics pertaining to chapter bond valuation, and this is our 7th video presentation. In today's video presentation, we are going to cover numerous topics. We'll start out with one of the most important and relevant topics for this particular chapter, and that is Malkiel's theorems. So before starting out with what these theorems are, I would like to bring your notice and kind perusal towards the person who has made these theorems. So it's always better to pay the honorable respect to the person who has made and brought certain kind of work towards any kind of discipline, disciple, or the kind of management works. So this person is Burton Malkiel, Burton Gordon Malkiel. He is an American economist and writer, most famous for his classic finance book. And the name of that book was A Random Walk Down to Wall Street. He is a leading proponent of the efficient market hypothesis, which contends that the prices of publicly traded assets reflect all the publicly available information, although he has also pointed out that some markets are evidently inefficient, exhibiting signs of non-random walk as well. Malkiel in general supports buying and holding of index funds as the most effective portfolio management strategy, but it doesn't think it is viable to actively manage around the edges of such a portfolio, as financial markets are not totally efficient. All during his life, he has done various amount of works for his universities. He has already worked out at Princeton University as well. There he served for a period of almost more than 20 years down there. Apart from that, he has already written out most influential articles as well, including that one, the valuation of closed-end investment company shares as well. And the same was presented in Journal of Finance in the year 1977. In that particular article, he did discuss about the puzzle of why closed-end bonds and funds companies typically trade at market valuations lower than the net value of their assets. If the net value and market capitalization are the only two ways of measuring the same thing, then why is there a consistent difference between them? He discussed about all these kind of relatively important and imperative topics all throughout his life. And such is a great man because he has not died by now. So may his soul long live for that matter. Hail Malkiel. So now let's get back to the point and we'll discuss about the topic for today. Malkiel's theorem basically summarizes the relationship between bond prices, yields, coupons, and maturity. His first theorem says that the bond prices move inversely with interest rates. Or in other words, we can say bond prices and yield move in opposite direction. His next theorem, theorem number 2, says the longer the maturity of a bond, the more sensitive is its price to the change in interest rates. In other words, we can say that the long-term bonds have more interest rate risk rather than the short-term bonds. Theorem number 3 says the price sensitivity of any bond increases with its maturity, but the increase occurs at a decreasing rate. For example, that means that a bond's sensitivity to interest rate changes increases at a diminishing rate as its maturity grows. So sooner or later, as and when the maturity is going to grow, the bond sensitivity to that particular interest rate is going to change increasingly but at a diminishing rate. Theorem number 4 says the lower the coupon rate on a bond, the more sensitive is its price to the change in interest rates. In other words, we can say that the higher coupon rates have less interest rate risk, And the last, theorem number 5 says, for a given bond, the volatility of a bond is not at all symmetrical. That is, a decrease in the interest rates raises bond prices more than a corresponding increase in interest rates lower prices. Stated differently, if we'll be like stating this particular thing in a different manner, we can say that the capital gains from an interest rate decline exceed the capital loss from an equivalent interest rate increase. So if we'll be discussing about the concept crux which we get from these theorems, we'll say that the price yield relationship is fundamental to the bond price behavior and is based on a principle that the bond price and yield move in opposite directions. This principle is derived from the fact that the price of a bond is equal to the present value of its future cash flows. That is, a change in the yield mathematically must produce an offsetting change in price in the opposite direction. Because the present value is an exponential function, the price yield relationship is convex, meaning that the bond prices rise at an increasing rate when yields fall and decline at a decreasing rate when yields rise. Next, long maturities have greater price fluctuation. Also, lower the coupon, the higher is the price volatility. And the third concept crux for Malkiel's theorem would be that the implication of Malkiel's bond price theorem to bond investor concerns how investors should act with regard to trading in bonds. Specifically, the two bond variables of major importance in assessing the price changes are coupon and maturity. To receive the maximum impact from an expected change in interest rates, the investor should purchase low coupon and long maturity bonds. So guys, that was all about Malkiel's theorem. Malkiel being one of the person who is actually having great understanding about market and its relevant understanding about bond prices as well. He was a person of great intellect and is actually the best kind of person who can give the clarity about how bond prices actually work out in the market. And he, even at such an old age, even I heard today as well, he provides lectures down there on bond markets as today even. That's all. So we must say that long live Malkiel for that matter. Now let's jump on to another topic of our today, and that is floating rate bonds. Coupons payable are adjustable in floating rate bonds. Adjustments are tied to an interest rate index like MIBOR. MIBOR is basically Mumbai interest based bond market risk, and LIBOR is the London based index rate, or 90 days treasury bill rate, and etc. Like most of these are basically depending upon the interest rate indexes of different countries or 90-day T-bill rate. Investors prefer floating rate bonds to fixed rate bonds because they pay interest in line with the market rates. Whatever is moving around in the markets, you'll be able to pay and get the same rates which are floating in the market in floating rate bonds. Whereas in fixed rate bonds, you'll have to pay a fixed amount of interest rate. Having said that, whatever is going in the market, you will not be concerned about anything regarding the same. Floating rate bonds address inflation risk as well. When inflation is higher than expected, the issuers of fixed rate bonds tend to make gains at an expense of lenders and vice versa. Because inflation risks affect both issuers and lenders alike in different situations, the floating rate bonds are preferred. Floaters reduces the inflation risk because the coupon rate is tied to the current interest rate, which in turn is influenced by the rate of inflation. Since floaters pay at the prevailing market rate to lenders, they always sell at or near par value. Therefore, they do not generally have call features. So guys, that was all about topic relating to floating rate bonds. So in any case, someday if you guys are going to invest in the bond market, definitely try your level best to ensure that you do invest in floating rate bonds rather than going for fixed rate bonds, because you'll be able to extract more out of the market in such a case. So now let's move on to another topic of ours today, and that is risk in bond markets. So in any kind of market, there are some pros and cons. You won't be able to get the entire benefits without having any kind of loss of opportunity or any kind of loss of any intended fall. So one has to bear these kind of cons as well in order to attract the pros. So let's discuss about these cons relating to the risks in bond investments. So the first one and the major one, which is the kind of essential limitation regarding the bond investments, is that interest rate risk. It is a risk that investors, fund managers, etc. are exposed to owing to an adverse interest rate movements. So for example, as interest rates rise, the expected yield also rise. So if tomorrow there is an information which gets floated in the market that the interest rates of each and every loan is going to get high, in such a case the expected yield which a person usually expects a kind of discount rate, and we can say their expectation gets high with that interest rate rise, and therefore in such a case the bond prices are going to fall, because certainly the kind of feature which prevailing bonds are allowing to the investors won't be able to meet out those expectations, and hence those bond prices are definitely going to fall. Conversely, when the rates decline, the bond prices rise. This is also called as price risk. Price risk ultimately results in a loss or a gain in the investor's portfolio. Of all the risks which are associated with the security like bond, this particular interest rate risk is a major risk. Next comes into the picture reinvestment risk. It is a risk that the proceeds from the payment of principal and interest have to be reinvested at a lower rate than the original investment. This risk is to be undertaken by all the investors who purchase any bond, including the government securities as well. The investor makes an assumption about the reinvestment rate expected to prevail over the planned investment horizon, and there is some problem with that. The investor may also make an assumption about the yield to maturity expected to prevail at the end of the planned investment horizon. The inability of the investor of not being able to reinvest the coupons at the desired yield as per his assumptions contributes to the reinvestment risk. In such a case, the condition outlined do not occur, and hence the realized yield will differ from the expected yield. So that is a problem which occurs to many of the investors, because they are not aware of the bond markets entirely for that matter. And this one risk is an important kind of a risk which is involved in bond investment market as well. So now let's move on to the third risk, and that is credit risk. It is also called as default risk. It is the risk of default on the obligation of issuer to pay the coupons and future value to the bondholders. It is actually defined as a possibility that a bond issuer will not be able to make the payment of interest or principal when they are due. Bonds issued by the government, that is G securities, for the most part are immune to this kind of default. So if any person is a risk aversive in nature, we recommend them to invest in government securities rather than going for any private corporation. State governments occasionally may default in such a case as well, though that case is also much less common. The bonds issued by corporations are more likely to be in default rather than as compared to the government institutions. The investors therefore seek more compensation in the form of default risk premium whenever they invest in corporate bonds. So guys, that was credit risk, that the investor, like the issuer, is not going to or may not be able to pay back the principal and the interest payments whenever they are going to do. So that was credit risk. Now let's talk about liquidity risk. It is the risk arising out of non-sellability of the bond owing to lack of buyers. Now let's suppose you have already invested in a bond and somehow the bond prices fall, and due to that problem there are lack of buyers in the market, and somehow you are in a state of liquidity crunch and you want to sell out those bonds to investors, but people are not there in the market who are willing to purchase your bond. So there comes into the picture liquidity risk. It is the risk which is arising out of the non-sellability of the bond owing to the lack of buyers. Bonds are generally more liquid during the initial period after issuance, as that is when the largest volume of trading in that bond generally occurs. All government securities are not very liquid. So guys, that was liquidity risk. Now let's talk about inflation risk. Inflation risk is the risk of loss in the bond value owing to inflation. If there is significant inflation over time a bond is held, the real value of the investment is definitely going to suffer. Again, this risk is to be undertaken by all the investors who purchase any bond, that also include common securities as well. This particular risk is also called as purchasing power risk. That let's suppose today you go and for purchasing of a bond for ₹100, and somehow the prices later rise, and that goes across to your pocket limit, and somehow if you are going to sell out in the market, the persons won't be able to purchase that bond at the price of 110, because that is going to limit their pockets, and that's why it is also called purchasing power risk. People won't be able to buy the bond at the inflated prices. Next comes into the picture market risk, the risk that a bond market as a whole would decline, bringing the value of individual securities down with it, regardless of their great fundamental characteristics owing to monetary and macroeconomic factors. It is the risk that the entire bond market as a whole would decline. That is called market risk. Let's suppose tomorrow, I'll keep my fingers crossed for that matter, but tomorrow somehow there comes war between India and Pakistan into the picture, as the situations are nowadays going on, considering the Uri attack, and now there is surgical strike for that matter as well. So if tomorrow a war happens between the two nations, so in the entire market in such a case, whether it's stock market, whether it's bond market, they are certainly going to get down, and in such a case the entire bond securities and stock market securities which are available in the market are going to suffer as well. So that would be the kind of market risk which could happen if somehow the entire bond market declines. Now the next comes into the picture, call risk. It is the risk that investors' principal is returned sooner than expected. Let's suppose some corporate bonds have this kind of call provision that was already discussed with you in our last presentations as well. Nowadays corporates have actually started out their launching of the bonds, incorporating with a feature that they can have anytime call provision in it, which will be invoked by the issuers in such a situation when there are declining interest rates in the market. Therefore, it is a situation where the investor's principal is returned sooner than expected, and in that scenario the investors have to reinvest the principal at a prevailing lower rate. So guys, that is going to hamper out the pocket for investors in such a case, because they won't be able to get the best price for their securities, and that is how they are going to suffer. This is called as call risk for bond investors. So guys, that was all regarding the risk in the bond investments. With each and every kind of pro, you'll be getting the con as well, and it's depending upon the investors how they treat out their risk as well as rewards in the market. Now let's move on to another topic of today's video presentation, and that is risk affected by the government securities. This question was basically asked in the year May 2011 examination as well. Of all the risks which are associated with the bond, the major risk relates to interest rate risk. That has already been discussed in the risk in bond investments in my last topic. So investments in securities usually carry various forms of risk. Of all those risks, majorly the risk relating to price and the interest rate risk prevails over all other kinds of risks. As the rates rise, the price of bond falls, and as the rates fall, the price of the bond rises. Consider the debt securities which are issued by the government. Their prices are usually and mostly governed by the policies which are being announced by government, institutions, and corporate. So they usually affect the dynamics of the demand and the supply factor of the nation as well. So government policies often give directions to invest and like interest rate movements. If in such a case the government policies restrain the money supply, they kind of block the money supply in the market, and in such a case the interest rates are going to rise, then in such a case the prices for the securities will fall. And let's suppose we'll have the exactly opposite case to there. If the policies are relaxed, the interest rates are going to fall, absolutely, and in such a case the prices for securities will rise. Various policies are being adopted by the government in such a case, depending upon the economic situation of the nation which is prevailing during that time. These policies include immensely licensing policy, changes in FDI, foreign direct investment, foreign institutional investors investment norms as well, restrictions on exports and imports, restrictions on shareholding in different industry sectors, change in taxation norms and security analysis and laws. So majorly the kind of risk which is going to get affected by the government policies is primarily interest rate risk, or we can say it is basically the interest rate risk only. So inflation is directly certainly going to get impacted in such a case as well, but the primary risk would be interest rate risk. So if in case the policies are being relaxed, the interest rates are going to get fall and prices of the bond will rise, and vice versa would be the case occurring with if in case a restrained money kind of situation arises as per the government procedures and norms. So guys, that was the risk affected by the government policies. This question was asked in the year May 2011, and with this I'll be winding up this video presentation with a thank you, and certainly I wanted to ask you and tell you regarding this one thing. Guys, keep interacting and keep asking your questions, queries in the comment boxes. That is going to help us understand your needs better, and certainly that will help us in providing you the best of the quality which you people generally require. So with this, I would like to say a goodbye and thank you on behalf of the Edupedia world. Stay connected, guys. We'll love to get and interact with you for that matter. Bye. Have a nice day. Take care.